I would just
Yeah.
introduce you to the participants in the summit. It would mostly be the structured finance professionals from across banks and non-banking finance companies in India.
Okay. Right.
And
Right. Right.
this is the 10th edition of our summit. We have, of course, not been able to get you in the past, but this time we've
Right.
been
Right. Right.
so very lucky to get your time.
Okay. Great. Great.
Thanks.
Yeah.
So
Yeah.
I'll straight take you to the questions there. And the first
Okay.
question I would want to ask you is about the economic value that you perceive in securitization with nearly 52 years of history in the US with almost $4 to $5 trillion worth of mortgage loans and other kinds of receivables being securitized. Does it hold value in terms of being the or being responsible for more affordable or more inclusive funding? Do you think it's been the region for more affordable housing finance in the country?
Yes. So I think United States on the mortgage-backed securities market is quite peculiar in my assessment. I wrote a book on this with my colleagues, Matt Richardson, Larry White, and former colleague Sten Van Nieuwerburg, where we think that primarily the securitization markets in the US are of the size they are because of the government sponsored enterprises support. So Fannie Mae and Freddie Mac and a couple others which are smaller, for most part they take over the credit risk of certain conforming mortgages below a certain size, meeting some loan to value, etc. thresholds. And because the credit risk is taken off the table when these mortgages get securitized, essentially it becomes a pure play on interest rates. In private label mortgages, as they are called, which is the securitization of non-conforming mortgages, where the credit risk will not be taken over by Fannie Mae and Freddie Mac, that securitization market basically was essentially a boom and bust cycle. I would say from early 2000s until the global financial crisis. That market has really not revived itself in much capacity at all, partly because the mortgage lending standards became much tighter because of regulation and maybe the lessons learned from the global financial crisis. And capital requirements for holding these assets have also gone up substantially. So I think when one thinks about securitization or the originate and distribute model for mortgages and looks at United States, I think it is primarily, in my view, the government credit support for a huge chunk of the mortgages that's the driver. If you look at the world over, securitization does exist, but it's in slightly different form, notably in the form of covered bonds in some European countries, and we can touch upon that later. But I would say that there is securitization in the United States in the corporate loan space. There is corporate loan obligations, most notably they are called as the collateralized loan obligation or the CLOs. And that is almost entirely private market. There is no government backstop there at all. It's a very clever self-liquidating capital structure that these corporate collateralized loan obligations have. And to me, that's partly a sign of sophisticated and deep institutional base. It's a sign, I would say, of financial innovation and legal infrastructure that drives the securitization. And third, it is a sign that bank capital requirements have been rising post global financial crisis, which makes it better for banks to originate, especially riskier loans, but then to distribute them to institutional investors who are funded more long term, unlike banks which are funded more relatively with short term paper. And then their capital requirements are either light or they have lighter touch regulation. So I think to me, the success of securitization in the United States as a private market outcome is greater in the corporate loan space, whereas the success of the securitization markets in the mortgage space is really thanks to the government-sponsored enterprises. Now, to be fair, though, as I said, there is interest rate risk distributed. There is a thriving market for that. But to me, that has flourished primarily because the credit risk has been taken off the table on the mortgages.
Touched upon several topics. You talked about the government market and the private label market, and then you talked about the CLO market. But let me just take some more inputs on the government or GSE supported market, as you referred to. You said this is basically risk assimilated and absorbed by the GSEs, which obviously have the support of the government, either explicit or implicit support. But eventually, if it results into a lower cost of mortgages to the homeowners, is it something that you would like to recommend as a policy choice for other countries? For example, in India, there is currently no absorption of mortgage lending risk by the government. And do you think if this is something which helps individuals to own houses and lead or sort of support the cause of affordable housing, is it something that you would recommend as a policy choice?
I've never actually been terribly convinced by it. These institutions are partly sort of creatures of the New Deal that was signed after the Great Depression in the United States in the 1930s. It was a very deep crisis, financial and economic, and there was a need to kickstart the housing markets. And so the government guarantees were created for that. But it's been sort of hard to put that genie back into the bottle because the system just can't be weaned off it, so to speak. So I think the trouble with these kinds of support is that it works well only if it is tightly regulated, which is that the loan to value documentation standards, the risk management of the government-sponsored enterprises themselves is maintained at very high and prudent levels. And what the checkered history of the GSEs in the United States shows is that as long as they are doing prudential risk management of reasonable standards, things have worked out okay. But whenever they've deviated, they've contributed to housing market access and either resulted in their own vulnerability or the vulnerability of the market as a whole. And the question then arises is that why should this prudential risk management fluctuate in the first place? And that's because there is mission creep because of political economy factors. Housing is a very popular currency to pay your citizens in, especially in the United States. And so usually there is sort of changes in the mandates, changes in the requirements, missions and goals are being set on it. And that debate, in my view, is not that different from the debates that we've had in India on, objectives of public sector banks. What are they trying to achieve? And, invariably or the other, sometimes they might be serving a good purpose, but there are times when they are available for politically expedient pump priming of the economy one way or the other. And so I think there are economies where housing is not as much owned and yet housing is available. Like Germany is a good example where rental markets thrive. Probably home ownership in Germany is not even 50% or it's somewhere around in that range. In our book, Guaranteed to Fail, we in fact had a table where the highest home ownership at that time when we wrote this book after the global financial crisis was in countries like Iceland, Ireland, and Spain, and they'd all had spectacular housing crises. So it seems to me that government guarantees are never priced fairly. Their scope is never regulated in a consistent manner over time, in a manner that they remain sort of distant from the political cycles that an economy might be experiencing. And I think in the end, people end up philosophically on one side or the other, whether there should be government guarantees or not. My view is somewhere in the middle, which is that it really goes through cycles. And to me, that's a sign that there is no guarantee that government support of mortgage markets will work well, because there will be mission creep, there will be political exploitation of these guarantee providing entities as and when they are set up. They will be run horribly from a risk management standpoint when pump priming of the economy and giving stimulus to the housing markets is politically convenient. And that these are risks that then have to be either accepted or taken into account or managed well.
Very well articulated. I think for any country which intends to support housing finance through government guarantees should bear these words of caution in mind. You talked about the risk transfer and the regulatory capital arbitrage, so to say, in the CLO market. And you mentioned that through a very efficient legal and regulatory management, the bankers have been transporting the risk, so to say, into capital markets, thereby gaining regulatory capital arbitrage. I have also, everyone is aware of your writings on, the potential risk transfers that perhaps wasn't real in the asset-backed commercial paper market or the CLO market, so to say. Post the global financial crisis, most of the regulators have taken steps to rewrite the regulatory requirements with more skin in the game requirements. Are you sort of satisfied with what is the existing regulation now with the minimum 5% risk requirement? Do you think that the capital requirements are now in good shape? And do you think the kind of risks which were seen in the US before the global financial crisis, are these of real concern to countries like India or developing markets which don't really have so much of thrust on securitization as of now?
Yes, I think I would say, the regulators are by and large good at fighting the last wars. And so, especially if you've had a crisis of the scale of the global financial crisis. So the rulemaking at the Basel capital reforms, and especially in the United States, with sort of very serious stress testing being done for systemically important financial institutions, I would say capital requirements are fairly high. Now, in some ways, that creates even greater scope for regulatory arbitrage by pushing risks off into the shadow banking system. And I think there the regulators have not done as much as I thought they might after the global financial crisis. Somehow the diagnosis of the global financial crisis has been more about capital requirements for banks rather than necessarily also harmonizing capital requirements within the financial sector as a whole, as they say, sort of regulate by function rather than form. So, if a mortgage-backed security is going to be held by entity one versus entity two, roughly given the risks on their liability side, are you apportioning capital requirements in a similar manner? Money market funds, I think, still remain vulnerable. I think they had to be supported at the time of the COVID shock again. And I think what to me is more disturbing is that the traditional shadow banks, such as broker dealers, the asset-based lenders, I think those have all, I think those are running their balance sheets more prudently than in the past. But I would say hedge funds contributed quite significantly to vulnerability of treasury markets at the time of COVID. Many of them were quite substantially levered on, cash futures trades in treasury markets. And when that blew up, the margin calls caused them to topple and liquidate their positions. The new suite of investments in debt mutual funds, ETFs, etc., where sales can take place or redemptions can be claimed, even if not on the underlying securities, but on the units of the ETFs. In case of mutual funds, you can, of course, claim redemptions of the underlying assets themselves. at the time of COVID, all of these seem to be like claims on liquidity. As uncertainty rose, everyone simply started liquidating in these markets. And so those who were supporting corporate bond markets until then suddenly withdrew their support all at once. So it looked like a run, in my opinion. It looked like demand for immediacy from these investors. It was as though they thought, of course, these markets should be liquid at all times. But once these fire sales took hold and bond markets froze, of course, then corporations started drawing down on bank credit lines. And ultimately, the risks got transported back to the banking system because the corporates that were reliant on the shadow banking markets ultimately had insured themselves against that risk through credit lines from banks, and they drew down these revolving facilities, and ultimately banks were on the hook for the shadow banking freeze that took place. So I'm not yet convinced that we have a good grip on the risks of the shadow banking system. It seems inherently still very fragile to aggregate risk and uncertainty. In one way or the other, the risk travels back to the banking system. The phrase I use is that the shadow always touches the feet. So shadow banking always seems to touch the banking in one way or the other. I think this is still work in progress as far as financial stability regulation is concerned, in my view.
Absolutely. So you talked about covered bonds a while back, and you referred to covered bond markets in Europe. This is something which doesn't exist in India as of now because there is no supporting legislation. Most of the European countries do it based on legislative support. So whether in conjunction with or as an alternative to mortgage-backed market, which is also not very great in India, would you suggest covered bonds to be a value for the housing finance market?
It's certainly an option. If you look at the covered bonds market, my understanding is that there's a lot of skin in the game for the original lender. They distribute, but then when the losses arise, the losses come back to the balance sheet of the originator. And it kind of shows this point I was making earlier, that ultimately the investors in securitization are comfortable with interest rate risk, but they want that the credit risk be shared or be borne by the original lender. And I think there is some sort of incentive efficient properties about that, which is that we saw at the time of the period preceding the global financial crisis that if credit risk is not on the table for the original lenders, then credit quality can decline very substantially because of moral hazard associated with that. But therefore, to me, it's also not surprising that the covered bond markets that exist in Europe are not as large as the securitization markets for mortgages in the United States. Now, coming to India, I'm fundamentally of the view that the biggest problem in India as far as corporate bond securitization and other markets are concerned is that typically the natural investors in these securities would be those who have long-term liabilities. Like in essence, if banks are finding it expensive to hold these on their balance sheets, you have to be able to share risks in the economy with someone else who effectively faces lower capital requirements because they have long-term liabilities rather than short-term liabilities. As we know, the Reserve Bank is trying to bring the prudential regulation of shadow banks or non-bank financial intermediaries, not all the way to that of banks, but closer to that of banks, both on credit and the liquidity side. Now, who are these investors? I think these investors, in my view, can be insurance companies, pension funds, hedge funds, etc. And we just don't have too much depth in the hedge fund space as of yet because, arbitrage, speculative activity should be allowed to flourish, but then fail. And there isn't as much capacity for these sorts of failures in the Indian markets. And as far as insurance companies and pension funds are concerned, we just have the real problem that the government deficits are so large, government borrowing is so large, that a preponderance of their allocation is always to government paper. In my view, our insurance firms, especially the government-owned ones, should not be allocating so much long-term capital to government paper. This capital should really get allocated to risk-taking for the private sector. So there's a fundamental crowding out of long-term investors' balance sheet by the sheer size of our government borrowing programs every year. And therefore, until that is brought down to manageable levels, therefore, I personally thought that adherence to the FRBM targets was very, very crucial. That is what would have given a fillip to private borrowing markets in the economy. But we are always pushing out those targets to some future horizon because we
There are
can,
compulsions.
because we can do that.
Mhm.
I think it's as simple as that. I think these targets are not binding. We don't have an independent fiscal council that holds government borrowing programs accountable. And so we keep shifting these targets away. And I think the whole essence and the purpose of the FRBM targets is a bit right now lost. And I think it's not clear to me what the targets are anymore.
Sure.
So I think until we fix the government borrowing and go through a serious period of consolidation for 3 to 5 years, I don't see how we can create space for long-term investors to bring capital to the securitization markets.
Absolutely. You mentioned about shadow banks in India, and you mentioned about the role of non-banking finance companies. One of the claims of the non-banking finance companies is that they are able to do lending at the last mile and add to the financial inclusion. These loans originated by non-banking finance companies typically end up on the balance sheets of banks, either by way of lines of credit or by way of so-called securitization, or in India, they call it direct assignment, sale of loans from the NBFCs to banks, or maybe the so-called co-lending, NBFC partnering with the bank. How do you see this partnering? Do you see any concerns in terms of risk still residing in the non-banking financial company sector? You mentioned about the regulations in that sector not being as strong, even though, as you mentioned, the RBI is largely aligning it. You are aware that there is a scale-based regulatory approach now, which is sort of equating those two. But still, of course, it's not as strong as in case of banks. So how do you see this partnering? Origination happening at NBFCs, ultimate funding coming from the banks.
Overall, I'm in support of sort of differentiated banking, or let's call it differentiated intermediation structures. Now we have banks, we have several asset-based lenders, we have some cash flow-based lenders now, especially with fintech innovations. We have small finance banks, we have payment banks. I think differentiated intermediation structure helps because it creates specialization and expertise in each intermediary for the specific functions they are providing. It also creates a certain amount of stability so that if one asset class or one business model fails, then the entire financial system is not hostage to them not getting recapitalized in a timely manner. I think so. In that sense, I view the growth of the non-bank financial intermediaries in India as overall like a healthy development. Of course, my assessment is, and I talked about this in my book on the RBI stint, The Quest for Restoring Financial Stability in India, that my assessment was that the easy money that was chasing the non-bank financial intermediaries after demonetization, because there was a glut of deposits, banks didn't know what to do with it, so deposit rates fell, and we had a surge in sort of liquid debt mutual funds, which were then funding these non-bank financial intermediaries. I think that growth was too quick. It was associated with very poor lending standards, both in housing and to some extent, I would say, even to the corporate sector. And ultimately with the housing finance crisis and ILFS debacle, all that came to roost. So I think broadly what I'm trying to say is that differentiated intermediary structures are good. I think it makes sense for those who develop the last mile expertise to be originating loans. If then risk bearing is cheaper somewhere else in the system, it makes sense to transfer the risks over. And this way you get sort of economies of intermediation in the process. But this is not to say that just because you have a last mile advantage, necessarily you are managing your risks well. And I think we have seen that NBFIs can also go through a leverage boom and bust cycle, as we saw post demonetization until 2018-19. And so I think I'm in support and favor of the steps that the Reserve Bank of India has taken to get a greater handle on this. My sense is they will look to do something similar in the fintech space as well, once it grows to be of a reasonable size. But that's the nature of financial sector. I think one thing to me that's a constant in the financial sector is that it always organically keeps evolving to the rules of the game. The way the financial sector looked 20 years back is never the same as what it looks from then on, and it will surely look different in 20 years from now. And so there's always a little bit of a catch-up game that the regulators have to play. Hopefully they are most of the times ahead of the game rather than catching up.
Very well put. So, I also wanted to ask you about securitization by banks in India. World over, it's banks which are the primary movers of securitization volumes. In India, banks are only on the buy side. None of them actually come up with securitization of their own receivables, despite some of them under pressure in terms of regulatory capital requirements. Do you think this is a case of lack of sensitization, or is it a considered call by banks for not opting to securitize?
See, my view is that it comes down to this issue of institutional depth for there to be buyers in the securitization market. And I think that until savings in the form of pensions, insurance premia, etc., aren't getting allocated in a large way to buying the securitization paper from banks, I think we will not see this changing, in my view, because the fact that banks end up in the end buying this paper in one way or the other, to me, is a sign that ultimately that is the only pool of low cost capital which is available to buy these securities, because the low cost pool of longer term capital, which in my view should be what drives the securitization market, is getting crowded out by the government borrowing programs. And you can see that we have reduced the reliance on banks over time. We have reduced the SLR requirements very substantially, from a peak of close to 40% to now below 20%. And perhaps it may get harmonized with the liquidity coverage ratio of Basel at some point. But essentially, bank balance sheets are not owning government paper as much as they used to. Of course, that means the government borrowing programs are now being more funded in the markets. And the question is, who's holding this paper in the markets? It may be mutual funds, it may be insurance companies, it may be pension funds, etc. In my view, unless and until the government borrowing gets consolidated away from 80 to 90% debt to GDP ratios closer to 60 to 70%, we will not see the freeing up of the balance sheet capacity of long-term capital that can give a fillip to corporate bond market, securitization markets, and so on.
I also wanted to ask you about non-performing loans in the retail space, particularly. Non-performing assets in India are mostly managed by the asset reconstruction companies, but that's mostly having to do with corporate loans. When it comes to retail loan pools, and you mentioned about fintech originated lending, which is also growing quite fast, and maybe a chunk of that might turn non-performing in time to come. Currently, there's no option of securitization of non-performing loans. Is it something that you would recommend? There is a market, I mean, assuming that there's a market, is it something that regulation should permit? Like in the US, the agencies have been doing reperforming loan securitization. So also in sort of several European markets, non-performing loan securitizations do happen. Is it something which the regulation should permit or promote?
Yeah. So if you look at the sort of non-performing loans market in the United States, of course, there is a set of vulture funds and hedge funds who are very active in that space. Then they go and become very active managers in the bankruptcy, etc. Our insolvency and bankruptcy code is still relatively new. It's still sort of, I would say, it's making good progress, but it's still steadying itself to some standards. I think greater pools of capital being allocated to managing distressed firms will still take some time because they want to see how this code stabilizes. Of course, we had the perhaps unavoidable suspension of the code during the COVID aftermath for a while, and that those kinds of events throw a little bit of sand in the wheels of investors saying, okay, let me set up a fund, and then suddenly, okay, we can't file. So at least from their narrow standpoint, these kinds of events are a bit of sort of negative shocks to their deployment of capital. On retail side, I think, but I'm still optimistic that on the corporate side, we will probably see more active distressed management players over time, because IBC seems to be handling at least smaller bankruptcies reasonably fast and smoothly compared to what we had before. See, on retail side, I would say the default rates in India generally have not risen to very high levels. Of course, unsecured borrowing has picked up, and there is a concern that if the economic slowdown that we have witnessed over the last 5-6 years was to not reverse itself very soon, then there could be stress in this unsecured retail borrowing, but that's something that remains to be seen. Usually these markets flourish when you get an episode of distress, because that's when people actually see an opportunity. Banks may be trying to offload the loans for capital efficiency reasons. Someone else therefore sees an opportunities because the prices on the loans might be attractive. But I think we have not seen, I would say, a large scale retail distress in India in sort of recent times, or at least in the history that I can think of. So I think it's an interesting thought. I still think there is somewhat of a stigma to retail defaults in India. If you think about our housing, my sense is we are back to sort of cash days of sort of pre-demon period. There's still a lot of cash part to the transactions, maybe less than it used to be. But one thing that doesn't get appreciated is that cash component of the transaction creates a lot of equity of the buyer. They are putting in a huge chunk of their money when they do the transaction in cash. So, not a big chunk of it is really on the borrowed segment. So I think on the retail segment, I would say the real risk is perhaps in the unsecured borrowing, credit card, drawdowns, etc. If wage rise remains muted relative to inflation, if employment scenarios don't improve dramatically over the next few years, there could be stress there. And then that might create a window where banks are looking to offload the risks. And then we have to see whether that will give opportunity actually to see players wanting to come in and manage the retail distress. Now, retail distress, of course, is not, in principle, loans above a certain size can all go to the IBC, but many retail loans will not fall into that category. So, I don't have great clarity on whether retail distress in bankruptcy in India is going to be handled at a fast pace and well, as and when it happens in a huge chunk of loans. Uh, but we'll have to wait and see. I hope it doesn't come to that situation, but usually you do need an episode of stress for these markets to develop and garner interest in the first place.
Resolution of insolvency for individuals has not yet been,
Exactly.
implemented. It's still not implemented.
Yes.
And
Yes.
one of the reasons for default rates to maybe start showing up in the NBFC space might be the fading of the COVID moratoriums and restructurings, which
Yes.
were done
Yes.
a year ago, and they are now fading, and therefore there might be a liquidity strain on the individuals. But as you mentioned, we hope that things remain good.
Yes.
So,
Yes.
my final question on the credit default swap market, CDS market, there is none in India as of now. The guidelines were recently rewritten. Is it something that, you of course have views on transfers of credit risk from the originator to the investor, but is it something that you would see as a healthy development in Indian market, or is it something that you would
See,
not?
it all comes back to the question of why there isn't much of a corporate bond market in India in the first place. And what the research is increasingly showing is that the success of the credit default swap market in the corporate space is not necessarily because of hedging demand, but because it becomes a standardized instrument to take a bet on the corporate credit risk. So every day you go in the market and you have a 5-year credit default swap, or now the maturities are standardized, but every 3 months there's a new CDS. So within 3 months there's a standardization of the maturity of the credit default swap. In contrast, bonds issued by companies are very specific maturities, coupons, and so on. So I think this view is important because it helps understand that the success of the credit default swap market may be inherently tied to whether you have a successful corporate bond market or not. Because it's really those who are wanting to invest and take on corporate credit risk are the ones who are seen to be wanting to be active in the corporate default swap market, because it becomes a standardized, constant maturity way of taking on credit risk in the market. Now, to the extent that a lot of our long-term capital pool is locked up in government borrowing, I don't see a thriving corporate bond market anytime soon, and therefore I don't see a thriving credit default swap market emerging either.
It's all coming from the crowding out principle that you referred to.
Exactly.
Right? Mm-hmm.
So I think to me, it is not so much of a product and market development issue as much as it is about changing India's macroeconomic balance sheet parameters. That we cannot see private capital markets booming in the fixed income debt space until the long-term capital in the fixed income space that should be taking on this risk is freed from the explicit or implicit restrictions it faces to keep supporting the government borrowing program.
Absolutely. So any final words that you would like to say to our participants? We don't want to take a lot of your time on that, but any final thoughts you would like to share?
No, I think my sense is, as I was saying, I think having a differentiated financial system in terms of sort of heterogeneity of intermediary specialization, intermediary capital structures can be a great source of strength for the Indian financial system. I think there are some exciting developments happening in the fintech space with, all on the back of the UID, the ability to do cash flow assessment by encapsulating the cash flow behavior directly from, either the e-market, the government marketplace, or, the GSTN network, or, it could be on sharing platforms or the gig economy platforms. So I think there is tremendous scope to do cash flow based lending in India on the back of financial innovation. I think there's the Open Credit Enablement Network, or OCEN, which is being developed in the India stack to facilitate a lot of this cash flow based lending. So my sense is, as long as risks are being managed prudently, I think in a country like India, where financial inclusion at the last mile, especially for small and medium-sized enterprises, needs to grow tremendously, I think there should be a lot of scope for growth as long as risks are managed well.
Thanks very much. Thanks very much for your time. And I think everybody's indebted. We all understand how busy your time is. So thank you very much for being present today.
Thank you so much for inviting.
Thanks.
All the best.
Thanks.
Bye.